All right. I know understanding deferred tax assets and deferred tax liabilities can be a little bit confusing just by reading it. So I created a little model here to help you understand how everything flows through the statements and where these assets and liabilities come from and how they can impact valuation. I've uploaded this Excel file at the bottom of this post. It is also located under my on my blog underneath the Excel files section. All right, so at the top of the model here, we have two hypothetical assets. We have a truck that costs $20,000 and a computer that costs $5,000. We then have the useful life for economic useful life for the company, and the salvage value for the assets. The Macker's life, which Macker's is the tax version of the depreciation schedule that we use. So they have different classifications. This is something that you can look up online and find out where they go with, or speak with a tax expert on that. These are the classifications that I use for this example, but they can be changed. And then we have the depreciation basis. Now, depreciation basis we know is the purchase price less the salvage value, and this is the amount that we must depreciate the asset by for book reasons. So, we're going to first go through the book depreciation schedule and income statement and the tax depreciation schedule and income statement, and then we'll see how these affect the book records for the balance sheet and the cash flow statements, and then talk about how it affects valuation. So to begin with, under the book depreciation schedule, for the truck we have simple straight line depreciation, which is what we assume for all of these, which is pretty typical for large firms, just to use straight line depreciation in their for most of their assets. So we start with the basis here, divided by the useful life all the way across for the 5 years, and again you would depreciate it longer than 5 years, but this is just what the model is showing. And again, the same thing for the computer. The depreciation basis divided by the useful life all the way across. Now, where this differs for tax accounting is that we use the Macker's life, or the Macker's depreciation. Now, I have a quick sheet here. This is the Macker's depreciation schedule I pulled up, and for 3-year asset, you can see that we depreciate 33% in the first year, 44.4% in the second year, and so on and so forth. For the 5, the 7, C, all the depreciation amounts. So, for this example, we have a 3-year truck, which says that we depreciate based off the purchase price multiplied by the 3-year, so 33.33 for this. And then for this one, it's going to go to the 44.45. Now, how the model's set up here is you don't have to worry about any of these. Up here, you can just change, if I want to change this to a 7-year useful life, it's going to automatically update. It looks up which row to use and which column to pull the depreciation number off from. If it's 0, it'll give you 0 value, but I'm going to change that back to a 3. So again, don't worry about this. It will show you the differences here. Now, for income statement, we're going to look here at a hypothetical income statement. I assume that we started with $30,000 in income and grew at 4% a year. We can see the growth here, and this is the same for both tax and accounting purposes. Next, cost of goods is going to be, it starts at a nominal figure, then grow, or it is, I'm sorry, it's 30% of revenue. Again, that stays consistent across both schedules. The operating expenses is 25% of revenue, stays the same across both schedules. Now, depreciation. Depreciation is the sum of the annual depreciation for, this is for book, and this is for accounting. So right here, we can see one of the big issues here within this line. For book accounting, in our first year, we have $2,500 in depreciation expense, while for tax accounting, we have $7,600, right? So that changes our pre-tax income by a significant figure. For this one, we have for book accounting, we have almost $11,000 in pre-tax income, and for book accounting, we have just shy of $6,000 for pre-tax income. Now, we take this is taxable income, so we now multiply the pre-tax income by the tax rate, which is set right here, and that will give us the taxes. Now, for this line, I do have it just titled taxes, but it should be a little bit different, because for book accounting, this is tax expense, and this is because this will be the amount of expenses that we record on our income statement for the given period, while this will be our tax liability that we owe to the IRS in that period. Okay, we'll come back to that in a moment. I also have set up here the effective tax rate, which is going to take the net income, it does take the taxable amount, the liability actually owed, divided by the pre-tax income. So this is the effective tax rate that we actually pay versus the nominal tax rate. But again, remember, for accounting purposes and U.S. GAAP purposes, we're going to record our tax here as our taxable income by our tax rate. Now, here in the balance sheet, I have some assumptions made up, and you can look through and see where these growth assumptions are coming from. They really are irrelevant. Cash is the only one we're going to come back and look at in a moment. But we can see that all of this is going to flow in. You're going to have your retained earnings is going to increase by your net income and grow every year, and then the rest of these will grow as well. But I really want to get into, and I do have a check figure set up here to make sure that your numbers are accurate, but I want to get into the cash flow statements. This is really where it comes back to. So we start with our net income, right? Then we have to add back, or we have to add or subtract change in net working capital. We have to add back depreciation for book purposes, okay, not for tax purposes. And then lastly, I have the delta here of tax payments versus book, which is essentially the difference of if we paid $2,000 but we recorded $5,000 in expenses, we have to add back the other $3,000 back to cash flow because we didn't pay it out. But then where does that go? And this again, it will flow into your beginning cash, ending cash, and it's a simplified version of the cash flow statement, but you can play around with that and get a better understanding of that. The key here is this section right here. So for book tax expense for this year, or for 2014, we had $4,300 in tax expense, but our actual tax or tax liability we had to pay was actually only $2,300. So we had a difference of $2,053. Now, what that will tell us is that our deferred tax liability, if it's positive, assets negative, says that, okay, while we recorded the $4,000 in tax expense, we only paid the $2,300, so the difference, the $2,000 some odd dollars, is the difference is still a liability because we are still going to owe it in a future period. So think of the basic journal entry. It'd be income tax expense would be debited for this amount, then we'd have a credit to income tax payable for this, and then a deferred tax liability credit for this. Now this line right here finds the cumulative or the accumulated deferred tax asset or liability, so it will add any differences here, and then this is going to flow back up into our balance sheet in either the deferred tax liability or deferred tax asset. Now the sheet's going to do all this for you. Don't change any numbers other than the green numbers. If you want to mess around with some of the starting numbers, everything else will model itself through. But that gives you kind of a basic understanding where the difference is. Now, the key here is for the valuation side of this. For valuation purposes, we essentially are always concerned about cash flows. And as you can see here, we have a pretty substantial cash flow, add back to our operating cash flow from the changes in deferred tax liabilities, deferred tax assets. Again, here I have it titled as change in, or the delta, the difference between tax payments versus book. That's to help you understand it better. The actual title might be different on a cash flow statement. But what you need to remember here is that if you're valuing a company and you have a short holding period, and you're doing a 5-year time horizon on it, and then going to terminal value, you need to consider where these extra cash flows, how this could impact your cash flow. So generally, you're going to want to create a tax accounting schedule versus just the book schedule, so that you can actually see what your tax liability will be for each year, so you can see how it flows in to impact your cash flows. Now, I understand this is a really simplified explanation of everything. I hope that it kind of sheds a little bit light on the topic. I have the model here. Feel free, play around with it. Make some sense of it and see if it helps you understand it better. If you have any questions, post away. Thank you.